Hello everyone and welcome back. Over the past couple of weeks, I have audited 12 portfolios from subscribers, people that just email me, contact me, we have a call, they just want some advice, they just want an audit of their situation, and most of the time the same mistakes happen again and again. The same traps that retail investors have in their portfolios. So in this video, I want to give you some mistakes that are showing up every time in their portfolio, because maybe this will be your situation. So I will talk about these 3 mistakes and give you some tools so that you can improve your quality of your portfolio and you can finally outperform the market. So yeah, I will draw some things. And yeah, I think we can pretty much start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And over the past few years now, I've created a coaching program, which means I help people improve their analytical skills and improve the quality of their portfolio to finally outperform the market. And you have one common mistake, which is over diversification. Too many stocks at the same time. Many people don't know what they are doing in the stock market, so they invest in a little bit of everything. I just had a call, 1 hour ago. That was the 12th portfolio. Too many stocks at the same time, which means too little focus at the same time. This person had a portfolio of many stocks, like more than 50, more than 60 stocks. And I asked him a simple question. Do you really know the 60 companies you have in your portfolio? The answer was no. He just watched a YouTube video that gave him some conviction, and that's pretty much it. And I see this happen too many times, too often. People steal conviction from somebody else on YouTube. People steal conviction from somebody on Twitter, and then they buy. And then when the stock goes up, they feel very smart. And when the stock goes down, they blame the other person. But I would say it's a mistake to do this, because you will not learn anything. It's far better to do the research on your own, to start the research process by watching a YouTube video. This is fine, everybody does it. And then you start the research on your own. You do the research so that you get to this point of big understanding, which means, how do you know if you understand enough about the company? How do you know if you have conviction? How do you know if something is inside your circle of competence? You have a couple of tools. I can give you 2. You have the first tool to know if something is inside your circle of competence. 1, can you pitch the stock to a child in 1 minute? In simple words, can you explain what the business does, how they make money, and how they will benefit from the future? If you can't, it means it's too hard for you. 2, if the stock goes down 50%, do you know why? Do you know why? You would be surprised how many people don't know this. I have audited many portfolios, and some stocks are in the red, some stocks are down, and people don't actually know why they are down. They can't even list 5 reasons why the stocks are down. Maybe because the valuation was too high, so the valuation dropped. Maybe because it's a threat of a new competitor. Maybe it's because margins are going down because of inflation costs or something like this. Maybe it's because of internal pressures from the management team. Maybe it's because of a bad acquisition with bad synergies that are destroying the culture of the company. Maybe it's because of something else. Maybe it's because of the tone of the management team. Maybe it's because of a decrease in guidance. You have many reasons why stocks go down. And a lot of people have a portfolio. They own too many stocks. And because they own too many stocks, they don't know what they own, which means they will make this stupid mistake. It's much better to have a concentrated portfolio of, let's say, 10, 15 stocks, 15 companies that you know really well. And if the stocks are going up, you know why. If the stocks are going down, you know why. By the way, not knowing why stocks go down or why things go down is another reason why I don't invest 1 cent in Bitcoin. If the price of Bitcoin goes down by 50%, I have no clue why. So Bitcoin is out of my circle of competence. Okay? You will never have a 100% hit rate. You will always have losses. It's a part of life. John Templeton said, even the best investors are wrong 1/3 of the time. So the best case scenario is you are right 2/3 of the time, 67%. This is your maximum. You will never be right all the time, which means you will always have losses. You will always have stocks that will go down. The key difference is knowing why. Why are your stocks going down? Is this a temporary problem or is this a long-term problem? And if you own too many stocks, you don't have the time to do the work like this, to know if this problem is temporary or permanent. If you own 70 stocks, you will not have the time. So to the 12 people that I audited for the past couple of weeks, the key advice was to reduce the number of holdings, to just focus their attention on some things that were really important. Because most people are retail investors. People watching this YouTube channel are individuals, retail investors. They have a job, they have a family. They are not full-time investors, which means they don't have an infinite amount of time. Your time is limited. Your money is limited. You have to do the best case scenario with what you have. And you will not be able to focus and perform good if you have too many stocks. So instead of having an over-diversified portfolio, you can have 10, 15, 20 stocks. Max. This is it. Maximum. You don't need to be a genius and invest in a little bit of everything. And actually, if you reduce your number of holdings, when you are right, you will make much more money. Because if you have a portfolio of 100 stocks, so 1% each, if you are right for one of your stock and one stock doubles, it will not make any difference. But then if you own 15 stocks and one of your stocks doubles, you will be very happy. You will have more conviction, you know what you're doing, you will learn a lot, you will reduce the mistakes, the number of mistakes you will make, and it's much more fulfilling because you actually know what you're doing with your capital. So it was the first point, that was the common theme that was coming for the 12 portfolios I audited. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And now the second one, the second error. This is people think a low price means cheap. So low price means cheap, which is not true. And I have some specific examples to tell you. A lot of people look at the PE ratio and they say if the PE ratio is low, it means the business is cheap, so it's a buy. And then they end up with value traps. You have a couple examples here. I have followed and covered Evolution AB on my channel, right? So it's an example like this. I can talk about PayPal, that is cheap, but the company has some problems. So people just buy because of a low PE ratio, but they don't care about the rest. So they buy because the PE ratio is cheap. Guess what? The business is getting worse over time. So the valuation, the cheap valuation is deserved, and the valuation is getting cheaper and cheaper and cheaper and cheaper until people give up and sell at the bottom. This is something that is happening much more often than you think. People just look for Intel, for example. They say Intel is cheap, so they buy just because the price is low, the valuation is low. Yeah, but if something is low, maybe it's there for a reason. Maybe the valuation is low, the PE ratio is low for a reason. Same thing for the car makers, Stellantis, Ford. The PE ratio is low because the quality of the earnings is low. Because you have cyclicality. Because these are companies that will be badly hit if we enter a recession. Because these are companies in the car industry that have a lot of costs. So they will not benefit from inflation. they will shrink margins. The margins will go down because these are very capital intensive businesses. So a low PE ratio is deserved because the earnings are not sustainable. You don't have how do you say it? A runway, a long runway of growth, a sustainability of earnings, like we have for MasterCard, for example. For Visa and MasterCard, you have sustainability of earnings. You know that in the next 5 years, Visa and MasterCard will make more revenue, more earnings, more free cash flow. It's almost 100% certain. What about Stellantis? Nobody knows. What about Ford? Nobody knows. I don't know, you don't know, nobody knows. Because these industries move a lot. These industries face many problems, especially now with Chinese competition, especially now with electric vehicles. These companies have sometimes bad capital allocation decisions. These companies have a changing management team. I know this quite well for Mr. Tavares and Stellantis. The guidance was great, and then they had problems. And in 6 months, the stock went down and down and down and down. They cut the guidance, they cut the margins, they cut the revenue growth. The CEO was kicked out of the company. A lot of things changed in only 6 months. Now you take the opposite scenario. MasterCard, Visa, sustainability of earnings, right? So a lot of people think that a low PE ratio means it's cheap, so it's a deal, so I buy. It's a mistake. So I'm not telling all the low PE ratios are traps, right? But you have to double check. You have to check the resiliency of earnings. You have to check if the PE ratio is low because of temporary problems, permanent problems. Is it justified? Is the whole industry like this, like trading cheap? Why? You have to ask some questions. And some people are lazy. They don't want to do the work. Well, if you are lazy, you can invest in the S&P 500. If you are lazy, you can copy my portfolio on eToro. This is public. All my friends are doing this. I have more than 9,000 followers over there. So you have copy trading platforms if you want to copy someone else's portfolio. So if you want the same results, the same stocks I am choosing, you go on eToro, you have a link in the description to just see my profile and copy my portfolio. If you are lazy, don't do your own stock picking. You will need some time, some investment, some nights of work, some good research, some hours and hours and hours of research to find the best stocks. If you are lazy stock picking is not for you. That's unfortunate, but that's life. Third mistake I see often is the ignorance of the cost of, that's an O, inaction. Cost of inaction. A lot of people sit on too much cash, regardless of their age, right? If you are near retirement age, of course you can play safe. You want to keep the capital, keep the wealth for your children, that's fine. That's a very smart way to operate and to manage your own business. But if you are 25, if you are 35, if you are 45, I would say most of the time it's a mistake. I'm not talking about people that keep 10% in cash. I've seen some people, subscribers, that booked a call with me, a consulting call, and they had the majority of their portfolio in cash, more than 50% of the portfolio in cash, and they are just waiting for a crazy scenario like 2008 to happen again, because they are scared. They are scared because they don't know how to pick stocks, because they don't have a framework, because they lack the conviction. Well, it happens. But I would say this happens a lot for young people, and it's a mistake. Time is your friend. You want to ride the wave, you will always find new investment opportunities. And we are retail investors. Some people argue the US stock market is expensive. It's okay. Go look in Japan. Find deals in Europe. Find deals in Latin America. If you are lazy, you will never do this. Again, if you are lazy, invest in an index fund or copy trade my own portfolio. But for those who are not lazy, you have very few reasons to stay in cash. You can do some short-term arbitrage, but staying in cash, the majority of your portfolio in cash for more than 5 years, will cost you a lot of money. And I'm surprised so few people make the calculation, the formula. For example, imagine you have a stock portfolio of $1 million, and let's say 50% of your portfolio, so 500K, is in cash. And you stay like this for 1, 2, 3, 4, 5 years. What is your opportunity cost? The remaining 500K of your portfolio, $500,000, let's say you make 10% per year. So that's the equivalent of 100K for the whole portfolio. You are not making 100K because the majority of your portfolio is in cash. Half of your portfolio is in cash. So instead of making 10% on your whole portfolio and making 100K profits every year, you're only making half of this, 50K. So every year that you are acting scared is costing you $50,000 every year. Past year, this year, next year after this, and that's $50,000 minimum because wealth grows. So that's 50K, 55K, 60K, 65K, and not a lot of people are thinking like this. But the cost of inaction is great. The cost of inaction is huge for some people. I've talked to people that were losing hundreds of thousands of dollars just because they did not calculate their own cost of inaction. Being lazy, just sitting on cash because you're scared, will cost you a lot of money for sure, guaranteed, because inflation is here. Because you will suffer immensely from inflation in the next couple of years. If inflation is 4%, all the money that is being sit right now in cash is losing 4% every year. So instead of benefiting from stocks in the long term, you are purposely destroying your own wealth if you stay in cash for too long. As always, the rich get richer. As always, now we live in a world with inflation, so asset owners will benefit. This is the world we live in. And because this is the world we live in, you need to adapt. Either you adapt or your wealth is shrinking every year. Choose your game. But I would say these are the 3 mistakes I see very often. Over-diversification, investing in stocks with a low price and thinking it is cheap, and a third mistake, the cost of inaction that is costing you a lot of money.
If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.